and welcome to Finance Concepts by your Finance-ista Cynthia Bush. Today we're going to talk about IPOs. So first, what is an IPO? Well, IPO stands for Initial Public Offering. It is the first time that a private company issues shares to the public. This process results in the private company then becoming a public company. And the buyers of the shares now become public company shareholders. The company receives money that investors paid for the shares, and they can use that money for a variety of things, including to fund strategic initiatives. But why do private companies IPO? Well, it is a very effective and efficient way for a private company to raise a lot of money very quickly. And by a lot, we mean billions, and in some cases, millions, and in some cases, billions. The IPO also enables the private company to have liquidity for its existing private shareholders, your angel investors or your venture capitalists who may want to sell out, and it enables the company to now have public stock that it can use to purchase other companies. But some private companies vow never to do an IPO for a couple of reasons. Number one, they fear losing control. Just as the founder of Papa John's. That company was a private company. It ultimately went public. There were a number of disagreements between the public shareholders and the founder of Papa John's, so that he eventually was fired from his role as CEO and ultimately decided to reduce his stake in the company and leave. It is a very time-consuming and expensive process, and we'll talk more about that later. When the company goes from being private to public, it opens itself up to have its actions now scrutinized very heavily by the public. That is a shock to some private companies who are basically used to doing whatever they want with impunity. And the now public company has to be very comfortable knowing how to manage its shareholders' expectations, which can be challenging. So let's talk about the road to an IPO. As part of the process, we have an entity involved called investment banks. These investment banks are matchmakers. They're out pounding the pavement, looking for companies that are private that have the potential to successfully do an IPO. The investment banks compete among themselves to convince these private companies to hire them to lead an IPO process. There are a number of things that the investment banks will help the company do as part of the process if it's hired. It will shepherd the company through the very complicated and time-consuming process. It will assist the company with the required legal and regulatory filings. It will help structure and run the roadshow process, whereby senior executives of the company go out with the investment bank and meet with potential investors to try to convince them to buy the new securities. The investment bank will help the company determine what's the right price to try to sell these shares to the public and how many shares should be sold. And the investment bank will try to support the securities once they trade. If it's an underwritten deal, which we'll talk about later, the investment bank will commit to provide money to the company even if the securities don't sell or don't sell at the price that the company and bank thought. So the investment banks, again, are basically matchmakers. In your personal space, we know some matchmakers, right? Match.com and Tinder. In the professional space, in this box are shown the names of some of the well-known investment banks who participate in helping companies with the IPO process. So they're effectively matching the issuers. These are the private companies who have decided to IPO with potential investors who hopefully will buy their new issued shares. So as I said before, it is a very long and cumbersome process to do an IPO offering. And I'll give you a brief overview. Number one, management needs to obtain approval from the company's board and its shareholders. Then, if they've hired an investment bank, the investment bank will help the company with regulatory filings, including filing a registration statement with the Securities and Exchange Commission, who is the U.S. regulator that oversees this process in the United States. There is a waiting period while the regulator is reviewing the registration statement and other documents, and during that time, the investment bank will help the company distribute a preliminary prospectus to potential investors. It will help the company conduct the roadshow I talked about earlier, and it will try to solicit feedback from the potential investors about how many shares and at what price they might be willing to buy. After the waiting period is over, if the SEC had no comments, then the company, with the help of its investment bank, will file an amended registration statement that specifies exactly how many shares they hope to sell and at what price. And then after that becomes effective, the company, with the help of its investment bank, is able to sell the shares to the public. So there are lots of IPOs that have been done. Let's take a look at the period from 1999 to 2020, where over 4,000 private companies went through the IPO process and became public companies. As you can see, a number of these are very well known. So these were private companies that decided it made sense for them to IPO, and they went through the process, in most cases, hiring an investment bank to help them along the way. But the road to the IPO is not smooth. In fact, there are many things that can trip a company up on doing this process successfully. Number one, shareholders may disagree among themselves and decide not to approve doing an IPO for the private company. Also, a company may run afoul of regulatory procedures, and that would be a big no-no. It's one of the reasons that many companies will hire an investment bank to help them with the process. They may get the approval from shareholders, do everything right from a regulatory standpoint, issue the shares to the public, and shareholders or potential shareholders in the public may be uninterested in the shares at the price. And so they may not buy them. And then finally, even if they are able to sell the shares to the public at a certain price, the shares may trade poorly after the IPO. Once the shares are sold, the company has its money. So if the shares trade poorly after the IPO, the company is not impacted from a financial standpoint directly, but it's a big embarrassment to the company and the investment banks who were involved. Now let's look at IPO costs. Let's think about putting these costs in three buckets. The first one is the spread, and that's actually the biggest cost. The next one are other direct costs, and then we have indirect costs. So turning to the spread, this comes into play when there's an underwritten deal. An underwritten deal is when the investment bank buys the new securities directly from the company at a certain price and then resells them to the public for hopefully a higher price. The company is in effect paying the investment bank for its services via this spread. The spread is calculated by subtracting what the investment bank receives from the shares when it sells them to the public and what it paid to the company for the shares initially. That difference is called the spread, as you can see in this description from Investopedia. Usually, the average underwriting spread tends to be somewhere in the 3% to 7% range. That's based on total deal size, but it'll vary a lot depending on how well known the company is, how well respected its products and services are, what industry it's in, how many revenues the company has generated recently, et cetera, et cetera. Note that the underwriting spread is the largest expense by far for the company involved. It is the reason that investment banks compete so fiercely against one another, because it is a very hefty fee for them, which they want. There are other direct expenses. These are all paid by the issuing company. They include things such as legal expenses, accounting expenses, and regulatory fees and taxes. All of these expenses must be disclosed in the prospectus that must be filed. Here's an example from PwC that took a look at 10 IPOs in the pharma life sciences industry that occurred from 2015 to June of 2020. And it focused in this particular instance on those companies who had less than 100 million in revenues over the last 12 months. And the overall IPO deal size ranged between 250 million to almost 500 million. Notice inside the circle, it says that the average range of the cost to do these IPOs was anywhere between almost 20 million to 36 million. And that the average underwriting fee paid to the investment banks was anywhere from 18 million to 30 million. That's a lot of change. And again, that's the reason the investment banks compete so fiercely for the right to lead the process so they can get those types of fees. There are also indirect expenses, also incurred by the issuing company. They include things such as if the company needs to put in a new organizational structure as part of the process for getting ready for an IPO, or let's look at the time that management has to devote to the IPO process, which is significant, and so therefore that's less time that management can spend on other activities. These types of indirect expenses, while they are incurred by the company, are not disclosed in the prospectus. There are also different issuance methods that companies can use when they're deciding to do an IPO. And here are three: underwritten commitment, best efforts, and Dutch auction. The underwritten commitment we've talked about a little bit before. It's where the investment bank commits to buy shares from the company at a certain price as part of the IPO process. The investment bank will then attempt to resell these shares to the public at a higher price. The companies generally like an underwritten commitment because they know how much money they're going to get because they get it right up front. The investment bank is the one taking the risk if the public decides not to buy the shares at that price. However, one of the reasons some companies don't like the underwritten commitment is because this method is the most expensive one for the company. Conversely, investment banks love this method because they earn the most fees on it. Now let's look at a best efforts. In a best efforts transaction, the company still hires an investment bank, but the investment bank and the company agree that the investment bank will only attempt to sell the shares to the public at a certain price. And whatever shares are not sold go back to the company. There is no guarantee by the investment bank, nor is there any payment upfront to the company in terms of how many shares will be sold or at what price. So the company is assuming all the risk for best efforts deals. And then finally, let's look at the Dutch auction method. This method isn't talked about a lot, but it is the method that is primarily used by the US government when they are issuing debt securities to borrow money. In the equity markets, it's used relatively infrequently. Peet's Coffee did use this when they did an IPO in 2001. And as another example, Google used a hybrid of this process when it IPO'd in 2004. As part of the process, many companies will still hire an investment bank, and the investment bank will hold an auction. And the auction will be online. So this is not a physical auction. But as part of the auction, potential investors are invited to bid on how many shares they want and at what price. The potential investors have a challenge, right? They want to ensure that they bid high enough if they're interested in this offering to win the right to buy the shares, but they don't want to bid so high that they drive up the price of the IPO shares. So in effect, the investment bank helps the company auction its IPO shares to the public at the highest price. There's no guarantee how much money will be raised, so the company is assuming this risk. But many consider this a more fair method versus the other two because anybody can bid in this process, assuming you have enough money. In the other two methods, the investment banks that the company has hired decide who they're going to talk to as potential investors, and those are the ones invited in terms of participating and buying the shares as part of the IPO process. Dutch auctions can be tricky though, and the results can be very uncertain. So that's all for now on IPOs. Until next time, this is your Finance-ista, Cynthia Bush, signing off.